Thank you so much for joining us today for what I think will be a fantastically interesting discussion about some of the reasons why we do the things we do, particularly in the realm of corporate finance. A bit of background about why we chose this topic today, and I think it all just starts with this notion of doing better at optimally allocating capital. And depending on the research you look at, whether it's this study or many others, there's ample evidence to believe that whether it's 20%, 40%, 60% of finance executives, there's a common belief that companies could do better in allocating their capital and being more effective in where they put their investments. And certainly one of the primary reasons for that is, as we'll discuss today, are decision biases. And these are human-driven inputs that tend to create forecasts that result in cost overruns, in time delays, and even in choosing projects that you may regret having chosen later on because of the way they were selected in the first place. And then really what I find particularly interesting, and I think you will too, and Victor will talk more about this, is that even when we know we've been biased in our forecasts and budget choices, even when we know that and we look back and say, oh, we could do better, we still continue to do the same thing over and over again. And why is that? And that's really kind of a super interesting thing to study, is like why, even though we know, we could be doing better, we continue to go down the same course of action. Those of us who look back at our capital budgeting process every year and say, next year we're not going to go through this the same way again, and yet you continue to do it the same way, I think can relate to that concept. So here's what we're going to do in the next 45 minutes or so. I'm going to give you a brief overview of Finario, because some of you are not familiar with us. We have many of our customers on the webinar today from around the world. So I don't want to belabor the point, but for those who don't know us, I'll give you a quick overview. Obviously, if you'd like to learn more, we're happy to tell you. Then our esteemed speaker will give you an introduction to behavioral finance and its implications for Capex budgeting. And then we're going to give you one of the antidotes to bias, which is reference class forecasting. Stay tuned, we'll tell you more about that. And another one of our speakers today will give you a look at how you can do reference class forecasting using the Finario platform as the canvas for that discussion. A quick piece of housekeeping: if you have any questions, please feel free to input them in the question panel on the right of your screen. We'll do our best to get to them at the end of the prepared session. Obviously, if we can't get to your questions, we'll follow up with you directly afterwards. So please feel free. If anything comes up as we speak about this very interesting topic that you'd like to learn more about, just put it into the question panel. So we are super excited to have joining us today Victor Riccardi. Victor is a visiting assistant professor of finance at Washington and Lee University, and the coordinator of behavioral and experimental research at the Social Science Research Network. That's a mouthful. www.ssrn.com. Professor Riccardi is a leading expert on the academic literature and emerging research issues in behavioral finance. He and Ken Baker are co-editors of the book Investor Behavior: The Psychology of Financial Planning and Investing, which was published in 2014 and part of the Wiley Finance series. His second book, Financial Behavior: Players, Services, Products, and Markets, with Kent Baker and Greg Philbeck serving as co-editors, was published by Oxford University Press in 2017. Suffice to say, Victor is a treasure trove of information around this emerging topic, and I think you'll be really interested to hear what he has to say. Also joining us is Bill Mayo. He is a solution engineer here at Finario, and he will guide you through this topic of reference class forecasting. And yours truly, Rich Feldman. I manage the communication and marketing here at Finario. If you like what you hear today, if you're intrigued and want to learn more about this topic of behavioral finance and corporate behavioral finance, you'd be well advised to pick up one or both of these books that Victor has co-authored: Investor Behavior, The Psychology of Financial Planning and Investing, and Financial Behavior. Both of these books go deep into the topics we're going to talk about today, and I think will give you a great overview of many of the issues and insights that can help you with your day-to-day jobs. So with that, I'm just going to grab a sip of water because my throat is getting a little croggy. So here's a brief introduction to us. So Finario is the world's most trusted capital planning solution. We're purpose-built for the modern enterprise. We provide a single source of truth for Capex and the financial intelligence for smarter capital decision making. We're the only solution in the marketplace that covers the full Capex lifecycle, including planning, budgeting, forecasting, approval workflow, and comprehensive reporting. We have users in 68 and growing countries across 28 plus industries. And at any given point in time, we have billions of Capex dollars being managed within our system. We're extremely proud of the company we keep, with fantastic brands like these, some of which are joining us today on the webinar. We cover everything, as you can see, a broad range of industries, from agribusiness to food and beverage, manufacturing to metals and mining, pharma to paper and packaging. If your company has a meaningful Capex budget, you can be certain that Finario is already represented in that category. Lastly, because we are cloud software and subscription based, you can count on a low total cost of ownership with no cost gotchas along the way. In fact, you can look forward to continuous updates and new features that keep you 2 steps ahead of best practices in capital planning. We can have you up and running in as little as 2 months, which is great. We integrate with all the leading ERP platforms like SAP and Oracle and Infor. We integrate with leading solutions in their categories like Coupa for procurement as source to pay, Procore for construction management. And in fact, we have several others that will be announced soon, so stay tuned. And perhaps most importantly, security is paramount. We're SOC 2, Type 2 certified, which, as many of you know, is the gold standard for data security. So I promised it would be brief. I lived up to my word. So now let's turn to bias. So many of you may have heard about books like Predictably Irrational and Nudge. And these have been kind of cornerstones in bringing mainstream attention to this emerging field of behavioral economics, particularly as it relates to consumer behavior. Well, there's an emerging field of behavioral finance as well, and that has followed suit to try to explain why investors often let emotions get the best of their money matters. And it's really, it has a lot of research and a lot of interest that you can Google at any time and find a wealth of information about. Corporate behavioral finance is an even younger discipline, and many of the same theories and theories around behavioral finance apply to corporate behavioral finance. And folks like Vic are helping to shed light on these, and that's why we thought it would be a great idea to have him here so he can explain to us, what behavioral finance is and how it might relate to CapEx budgeting and forecasting. So without further ado, I'll turn it over to Vic and let him walk you through that. Vic?
It's great to be part of this wonderful endeavor today. And just to also give you a little bit more background, most of the research in behavioral finance is really focused on financial planning process and investor behavior. The wonderful thing, though, is I also have a background in which I've been teaching the traditional corporate finance class for 25 years. So I have that at least teaching experience. And now, as I've been teaching that traditional class so long, it's nice to be able to think about and advance behavioral corporate finance. Also makes my class a little bit more interesting and so forth. So before I even discuss what behavioral finance is, I just wanted term traditional or standard finance. That would be the typical finance perspective that most of us have had in the school of business, talking about rationality, efficient market hypothesis, and modern portfolio theory. So that's kind of the standard of what most of us have been exposed to. Behavioral finance has been around for about 25 or 30 years, and that takes more of a aspect of a psychological piece. So if you've ever taken an intro to psychology class, many of those basic topics are just being applied to the context of finance. So and that could be on a group level, an individual level, or a market level. So the three main buckets of biases to think about are what's known first is heuristics, which is a cognitive process. Essentially means it's a non-emotional. So an example might be in capital budgeting would be maybe when you're doing forecasting models, you're anchoring or you're focused on the initial investment of a project and then the next project. And you're really, that anchor is just focusing on that piece of data. I'll also give a little other examples a little bit later. Then there's an emotional aspect to our decision making, and that could be positive or negative. And my perspective from this, especially in advising many financial experts, is try to make decisions when you're in an even temperament uh, uh, environment. We don't want to be making decisions when we're overly emotional either way, because it also um, affects our assessment of risk, which I'll talk a little about. Then we have a combination of what's known as the affect heuristic, which is really talking about our cognitive mind and our emotional process. So in a capital budgeting aspect is maybe we have maybe we're doing a forecasting model for an EV car or an electronic vehicle, and we have that emotional attachment in which we are a big believer in EVs. However, the numbers and that's the emotional or the affective part. However, the um, the outcomes don't necessarily, of our financial analysis, support investing in EVs. So then we wind up using a cognitive bias to maybe find the probability of the best case scenario to underline maybe only 10% of that outcome or forecast model would have been applicable. So that's where we kind of have that affect. So our mind works with emotions and cognitive biases at the same time. So the first bias, and this is an example of a heuristic, in which, and the way to think about a heuristic is, I said, it's a mental shortcut. So what representativeness is the idea of taking a small sample of information or data and drawing a major conclusion about it. So the example I give is, let's say, financial managers predict the capital budgeting performance by relating it to a previous project. So if a classification of a certain project was using a certain method of capital budgeting may have been successful, we draw the conclusion that that methodology and that type of project will always be successful. And the same way on a negative representativeness. If we had a failure, we may ignore those type of projects going forward because our NPV wound up being a losing project, even though we thought it was going to be successful. So that's an example of the representative bias. The next one here is what's known as anchoring. So the idea is that we focus on a piece of information as a reference point. So that can be on a daily basis, an hourly basis, going back to the financial crisis of 2008, for example. And so an example here would be a CFO places too much emphasis on a certain type of capital budgeting method. Let's say they prefer NPV over IRR, and they anchor on it because that's maybe related to the success of the project. Rather than a rational strategy may be to look at a thorough portfolio approach of looking at all the different methods and seeing what the results are. And as Rich alluded to, this is one of the biases is even once we recognize that we are anchoring, eventually we will start suffering from anchoring again. So you have to be very cognitively aware of having guidelines and structure in place to try to avoid some of these biases as well. So this wonderful graph is really the foundation of behavioral finance. So if you look in the middle of the graph, that reference point is an anchor. So in modern portfolio theory, we say every stock we should buy should be viewed in the context of a portfolio. This graph is saying that's not happening. So even every project, let's say another example would be, let's say your firm does 100 projects in a year. Well, the project that you're thinking about should really, according to modern portfolio theory, would be you should think about that one project in relation to the other 100 projects. But as human beings, we don't do that. So that's what this anchoring piece is also showing. Also, you have this curved line. In standard finance, this would be a straight 45-degree angle, meaning a $10,000 gain on the upside in standard finance would feel like a $10,000 loss on the downside. The psychological experiments show that's not the case. That $10,000 gain on the upside in behavioral finance feels like on the downside a $20,000 loss because it's an emotional loss. And so that's what's known as profit theory or loss aversion. But then if you add the emotion to it, on the upside, we suffer from what's known as the disposition effect, where we will cash in potentially a project too early when we're making money. On the downside, the disposition effect shows we hold on to losing projects or losing investments too long because we don't want to admit that we made a mistake or experience the emotion of regret. And the other side note here is when you're thinking about this is also showing that we tend as human beings to think in terms of dollar amounts. So even something like an NPV is a dollar amount people don't necessarily think in terms of percentages, which would be an internal rate of return. So even cognitively, we're more likely to favor an NPV value because it has a dollar amount and an IRR. And then if we extend this further beyond the 5 traditional methods of capital budgeting, and you think about something like the profitability index, I think also people also like ratios because the probability index helps you think about things as a pure unit basis. And the similar analogy would be in the context of modern portfolio or investments when standard deviation by itself doesn't tell you anything. But things like the Sharpe ratio and the coefficient of variation give you that per unit basis. So when you're thinking about making that analogy between corporate behavioral finance the profitability index lines up very well in investments, I think, with the Sharpe ratio and the coefficient of variation, because they both give you that per unit basis of being able to compare different size projects along with comparing different size investments or stocks. So that's something that I just wanted to make a point about. The next piece of this, and this is related to loss aversion and regret. So I don't have this on a project basis, but this shows you the impact of a stock investment. So if we sell a losing investment, we regret initially purchasing the stock, and we're less likely to repurchase it. So then you may, if that happens in the context of a project, you may be less likely to invest in a similar project of a similar nature. If we sell a winner, and which we made a gain on something, or we had value, and the price increases, we regret selling it too soon, and we're less likely to repurchase it. The only time in which we sell a winner, and if the price declines, we're happy about profit timing, and we're more likely to repurchase the asset, or as well as the project. So I don't have research that directly relates to capital budgeting, but I just thought this is such a wonderful study. It shows the powerfulness of how regret and losses and gains affect our decision making to repurchase a stock or potentially take on a similar capital budgeting project in the future. So the other two buckets to think about is thinking about overconfident decision makers versus status quo decision makers. So overconfident people tend to have too much hubris. We have too much faith and trust in our forecasting abilities, in our outcomes of NPV, of the probability index, of internal rate of return, and so forth. So this, so an example would be we tend to overestimate revenues, and we tend to underestimate expenses, say on the income statement. The study in 1999 showed especially people who are more entrepreneurial and they're in more of a younger company tend not to just suffer from representativeness, but also they tend to suffer from overconfident behavior. But I would say as human beings, we suffer from a degree of overconfident behavior. How many times might you be asked, do you think you're an above average driver? How many people in a room would admit that they're a below average driver? Not many people. So that is just that question alone is representing overconfident behavior. So the opposite of being overconfident is, let's say you're on a well-established company, you're making good profits, and you then suffer from inertia. You use the same techniques, and the bias would be the same modeling, but that inertia also could cost you in the long run because you still have external environments to worry about, external factors. Even just doing a SWOT analysis of strengths, weaknesses, opportunities, and threats is one way to alleviate this type of bias. And then if it's in a group, let's say you have a team of 10 people who are looking at a project and everybody has the same opinion because you have a dominant one or two people in the group, that relates to status quo bias, but it also brings on the notion of groupthink. So I think one of the ways to overcome this might be if you have a team of 10 people, maybe have one or two people who are going to act as contrarians to overcome why you shouldn't do a project. And so that then helps overcome the bias, but it also, you're giving a wider point of view to providing better decision making in your overall organization. So this one is, I like this. A lot of my research focuses on risk-taking behavior. So another way to think about what is the culture of your company? Are you risk averters or you're risk seekers? Also, it may be, as I said, it's the type of company you are, entrepreneurial, younger versus a well-established industry. Um, the risk averter is going to be a firm or a culture that doesn't like uncertainty. So that's more of a status quo bias environment. The risk seeker or the overconfident behavior is going to be firms or a culture that likes uncertainty. I think the lesson here is to try to have a middle ground and try to have a balance. You know, too much risk taking leads to bad decisions and even unethical decisions. Status quo behavior or being too risk conservative leads to complacency. So trying to push your company some in the middle somewhere, similar to what I tell clients uh, or financial professionals when they're dealing with their clients, is trying to find that middle ground is the best way. So this particular um, or illustration shows. So in traditional or standard finance, we're taught that it tends to be a positive relationship between risk and return, meaning a higher beta stock results in a higher expected return. But that is based on historical return. If we're looking about the perception of something, so another major aspect of thinking about behavioral finance is we tend to like familiar assets or familiar names or familiar projects of past experience. So let's say on the left side of this graph, let's say you have a familiar project that has a history of doing well, you're more likely to perceive that as lower risk but yielding a higher return versus a new to the right of the graph where we have an unfamiliar project or a project with a lot of uncertainty in our forecasting, we may more likely to have it perceiving it as a higher risk and lower return. And so this is very hard to measure because this is typically done with survey data because it's looking out to the future. But that just gives you an alternative view of that standard finance perception. This is essentially showing that there's an inverse relationship between perceived risk and expected return. So the other very powerful how we make decisions, and this is especially, I think, important for CFOs or if you're a leader of a team, how do you communicate or you frame your decisions to your team members is extremely important. So there's a psychological experiment that says, would you rather invest in a new enterprise for selection A that has a 50% probability of succeeding versus B with 50% probability of failing miserably? Well, obviously the choices are the same and you should be indifferent. But 2/3 of subjects, or about 60% or more people, choose selection A because it has a positive rate. So the other thing, and so this is an example of, I alluded to the effect heuristic. Well, this is showing what's known as two different models of decision making. So, for example, if a person is in a positive mood, they're more likely to say they're happy, they're more likely and willing to accept higher risk projects, and then they're more likely to accept a project. Versus the mood maintenance hypothesis does the opposite, and which says, let's say we're in a positive mood, we become more complacent, our bellies are full, and we don't feel like taking on as much risk, and so we may reject a riskier project. And it also works the same way as if you're in a negative mood. So your mood does count. There's even research that shows subliminally, if you take two groups, and let's say one group was going to buy a mug, and the other group was just going to go online, but the other group was shown a negative or a sad story or a video before them, that they wind up that unconsciously they don't realize that sad video is behavior. Just like bad financial news in the morning may affect your behavior, and those people wind up paying 4 times for the price of a book. So our subconscious is very complicated when we make decisions. So I think, as my grandfather used to say, sometimes shut off the idiot box. And when you're making important decisions, tune out social media, turn the phone off, and make sure you're in a good, complacent, non-emotional environment for making very important decisions. I think this is a lesson there. And then the I'm sure we've all taken in high school either a personality test, so the big five, thinking about risk assessment. And so extroverts tend to be people who are, like me, very talkative, characteristics. But also in a group, we tend to be more dynamic, and we may also be more likely to sell a project. Versus other people who are too agreeable this also relates to the aspect of status quo bias. Or groupthink, they may be more likely to agree to a project within a team. Other people who are conscientious are more likely to take a more long-term view. And again, it's not that we are absolute each of these particular personality traits. It's that we each have a degree of them, and thinking about how they're affecting our decision making, also in the context of a team. And the one that always gets the most interest is people who are highly neurotic. There's something called people who are called financial psychopaths, and 1 in 200 people in the public are classified as psychopaths. And unfortunately, Wall Street tends to attract even more of them because of the idea of greed and money. But that's more of the joking piece. But we're all a little bit neurotic. So even a scale of what neurotic is really a proxy for is control. And it doesn't mean that we're trying to control each other. It's that we think we can control the outcomes of, say, of the financial performance of a stock or a project. Or when you're thinking about control and being neurotic, think about your management style. If you're too controlling, you're not putting enough trust in your team. Versus if you're not taking enough initiative or control at all, and you're putting too much in your team, it's not a good thing either. So balancing out that personality across your team members is finding a middle ground between trust and control. And then it's also good to have people who are open to new ideas and so forth. So the next piece is really the rational planning process. So, traditional finance is based on the idea of maximizing shareholder value, taking on the best projects, the ones that will give you the highest NPV, and so forth. I think as financial managers, we have planner personalities. It's just in our context. I wasn't always a behavioralist. I started off as an accountant, so I have that very structured personality. I got religion though. So anyway, as we feel that these structured guidelines and how we analyze a project really create a sense of security, control, and safety for us. So that in itself is a bias when we're thinking about things, because that safety and that certainty aspect of the planning process doesn't always take into account the ability to measure something like uncertainty. How many of us in our models would have had a 100-year pandemic, the worst inflation in 40 years, and a Ukrainian war the past 3 years? And so it's not that we could have predicted any of these events. I think it's thinking about how are we modeling and how we are preparing for worst case scenarios within our own overall projections and financing as part of the planning process is the lesson. Then the planning fallacies deals with the idea that people are inclined to underestimate or misjudge the time required to finish a task, given the reliance of past. We tend to be over optimistic about um, past financial performance, and that's going to equate to future financial performance. I mean, do it with everything. I mean, I do it with book projects. I did it with the presentation of preparing for this. Maybe I said, oh, this is going to take me 10 hours to do this presentation. Maybe it took me 20 hours. So it's inherently, we have a inability, whether it's related to overconfidence, but forecasting and the optimism of getting things done is even difficult for even someone like me. So individuals tend to be optimistic about the future, causing an underestimate of outcomes or weighting less in what was negative. So people, we tend not to learn from the past. So we have a tendency to overweight the future of something and underweight past experiences, especially if those past experiences were negative in nature. So we won't weight them as much. Then, when you're thinking about the planning fallacy in terms of projects, it deals with underestimated revenue projections, uh, high cost overruns, missed deadlines, and poor outcomes for estimated versus actual results from the various capital budgeting methods, such as NPV, IRR, and even the discounted method, and so forth. And we as human beings, especially men, I haven't mentioned this before, but in neurofinance, we have a lot of testosterone. And so that's one of the things is it's not just experience that drives our overconfidence, it's our biology. So just to give you a little teaser on that. So even as human beings, we are sometimes primed to be overconfident and over forecasting. And as I said, we don't always recognize that our overconfidence of the past will also impact our forecast for even rosier forecasts in the future. And so when you're thinking about the planning fallacy, it has connections to many of the other biases that we spoke about. So it can deal with heuristics, loss aversion, overconfidence, the status quo behavior, the groupthink, the affect heuristic. So this is a very simple introduction into understanding. Sorry to tell everybody is that we're very complex individuals. And I have many biases myself. So my position is if you understand your biases and you implement a rational strategy, that's how you overcome the biases. So I don't necessarily, I have a great enjoyment of the tools of standard finance and traditional finance. I just disagree, as a behavioralist, I disagree with the underlying assumptions.
Wow, that's a lot to consume in 25 minutes. It's so thought-provoking. Thank you.
My pleasure.
Awesome. So we're going to pivot now. So we just talked about many of the ways in which heuristics and other things get in the